Hello and welcome to our latest Insider interview. In the studio, I have with me Edmund Harriss, Fund Manager of the Guinness Asian Equity Income Fund. Edmund, thanks for coming in today.
Nice to see you.
Edmund, when I last interviewed you on camera, which was during the pandemic around 3 years ago, the fund had around a third of its assets in China. Today, the fund still has around a third in China. Could you talk us through the investment case for China, particularly given the fact that it's been a poor couple of years for its stock market?
You're quite right. Our China allocation remains the same, around a third of the fund. The long-term investment case for China is households growing wealthier, a manufacturing base that is becoming ever more sophisticated, and frankly, low valuations. The concerns around China at the moment are surrounding the move from property sector driven growth into longer term industrial growth in areas such as sustainable energy, telecommunications technology, electric vehicles, and the like. There have been concerns that as the debt associated with the property sector unwinds, that the financial system may come under strain and may in fact be a fundamental risk. And that has caused valuations to drop significantly. So China's long-term valuations are trading at multi-year lows. They haven't been this low for over 10 years. So what we are doing is looking for businesses in China that are still operating and producing superior returns. They are still able to successfully grow profits in an environment where valuations are still low. We can see that they're doing well because the dividends are still coming through and the dividends are still growing. And so we see no reason to change that. But it is possibly the best sort of long-term investment opportunity in that portfolio at the moment.
Country weighting that stood out for me is that you have 10% in the US. Some other investors may be surprised to see that, given that you're investing in the Asia Pacific region. So why do you have exposure to a developed market, and how much can you have in the US?
We do have the opportunity to invest in companies that generate over 50% of their revenues from within the region, but are listed and traded elsewhere. It's not a huge number. There are about 25 such companies in our investable universe, as we define it. And so we can pick one or two of those. We've got 3 names, 2 of them technology names. One of them is an insurer. So in the technology area, we've got Broadcom, which is chip designer software services. Qualcomm, which is a chip designer particularly focused on the smartphone area. And we also have Aflac, which is a healthcare insurer with a very large business in Japan. These just add an extra opportunity to the portfolio. We have 10% because we have 3 names in those, 2.75% in each. They've done well, so they've now account for around 10% of the portfolio. We don't have a hard limit on how many companies we can have. You know, with 25 names traded outside the region versus another 600 or so that are traded within the region, we would expect really this to be the majority of holdings will be Asian companies listed and traded in Asia. But there are some interesting opportunities out there. Qualcomm is a big provider for the Chinese smartphone providers, but also to Apple, which is manufactured in China. So about 65% of their revenues are coming through from Chinese facilities. Something like Broadcom, which is a big beneficiary, by the way, of the AI theme as well. But they are generating revenues from around the region, from Taiwan, from Korea, from China. It's a Singaporean company originally, but with headquartered in the United States. So, you know, we're still looking to generate Asian exposure, but we're not going to be too dogmatic about where we're going to find it.
I next wanted to ask you about India. It only comprises a very small part of the portfolio. So why are you not finding opportunities?
Well, it certainly is at the moment in terms of the weighting. A lot of good companies in India. They trade very expensively. When I say good companies, I think in terms of their returns on capital, they're good. Corporate governance, not so good. So it's quite a sort of a tricky area to invest in. We've had a few false starts in that market. We've got one name at the moment in the form of Tech Mahindra in the IT services area. There are one or two other names that I am interested in, but are relatively more expensive than opportunities I found elsewhere. So for the present, we just have one name. The Indian market has done very well over the last couple of years or so, primarily driven, in fact, by domestic Indian investors. I don't think foreign ownership levels have increased significantly over the last couple of years or so. So it's been quite an interesting dynamic there. But if we just look at relative valuations, and we express these valuations in terms of sort of multiples of earnings, India at the moment is trading on around 18 times annual earnings, whereas China is trading on around 10 times annual earnings. And if we have a look at the growth between the two, the growth there is faster than we see in China. Both of them are over 10% growth, but China is trading at these much lower multiples. So I tend to tilt that way. But it is a market that is included in our universe. We're always looking for ideas there. I think good ideas are quite hard to find. A good idea means you've got to have a good company. The profits have got to be there. The dividends have got to be there. But then it has to be priced at a level that doesn't fully reflect that. And that's where the sticking point is for me right now.
Investing in the Asia Pacific, it's more of an adventurous investment area. So it's important for investors to take a long-term view. Are there any particular risks at the moment that are concerning you for your strategy?
Well, it's an interesting question, that one, because what we're seeking to do is to take the adventure out of investing in Asia by looking at companies that for the last 10 years or so have a track record of superior performance on a global comparison basis, never mind a domestic one. Our focus, therefore, is on companies that have access to international marketplaces for their products, but also have a lively domestic marketplace also for their goods. So when I'm thinking about risks associated with that, it is risks to those businesses. Will that be taken away from them? So we have geopolitical risks that are often talked about. So we have to think about that. We have local politics and economic policies and industrial policies to think about. Regulatory evolution, whether or not those are going forward or backwards, whether the regulation is helpful, providing clarity and structure to a market and order, or whether it is actually disruptive and is playing to vested interests. So all of these need to go into the mix. But I think from our perspective, your research and the research questions have to distill down to two. At a business level, will the returns of the past persist? And does the current market price reflect that? So two questions and two then channels to think about. In the first one, will the returns persist? Is the operating environment for that business stable? Is it a fair playing field? Is there a market for this business? Is it growing? Is there cash associated with it? Does it have investment opportunities? All of which are designed to decide whether or not the cash flows and the dividends we see from them are coming. And then we have the market question. And the market question is a function of what do we think about the business, but it also thinks about what do we think about inflation and interest rates and what the Federal Reserve is going to do. And it also comes down to whether or not the political environment is stable, whether or not there is going to be some other sort of exogenous factor that throws out valuations. But it is about building blocks. But I think that the approach of buying quality businesses has been tested quite thoroughly over the last 10 years or so. We've had a couple of China slowdowns. We've had Brexit, which cast questions over the European financial system. We've had a pandemic. We've had major disruptions, therefore, to business. Were our companies able to survive and thrive in that environment? And the answer is yes. They have produced a steady set of returns that is consistent with 6% average annual earnings growth over that period and around a sort of a 3 to 4% dividend yield. And the returns from the portfolio have reflected that. But you're right, it's a long-term view you've got to take because, say, as an example, through that COVID period, the market took a very dim view of Asian companies and sold them off hard. And yet during that period, the companies themselves continued to perform very well operationally. And it took 2 years for the market's assessment of that profitability and the underlying performance to come back into line. If you were able to have confidence in those businesses, setting aside what the market thought about it at any given moment, you would have done fine.
And finally, Edmund, do you have skin in the game?
Yes, I do.
That's great to hear, and thanks for your time today. So that's it for our latest episode of our Insider Interview series. Hope you've enjoyed it. Please let us know what you think. You can comment, you can like, and you can subscribe. And hopefully, I'll see you again next time.